Big tech has had a rough week this week with, are we going to include Spotify in big tech here? That's kind of medium to little tech really, isn't it? But Google and Microsoft released their earnings yesterday, and they have fallen quite considerably. This is being recorded on Wednesday evening. So we have, I think, Google down 9% on its earnings and Microsoft down only 7% on its earnings and guidance this evening. Who wants to take me through Google?
I'll start on Google. As you pointed out, stock's down around 9%. It missed its earnings and it missed its revenue as well. In one case by significantly more than another. I'll go through the numbers to start off with and we'll kind of come back to the views bit. I'll flip it over to Steve. We mentioned kind of the US market a little bit earlier for what it's worth, and you asked about sentiment, Paul. I mean, one of the things that I think kind of goes a long way towards defining sentiment is that attitude towards big tech. And Google's earnings, and to an extent Microsoft's as well, and general concerns about the state of big tech. The US indices are, they're not dominated by it, but they are, tech is a large part of that index, and
50%.
the big parts of it, so there's significantly they go as big tech goes, in a number of ways. So that's, I think, weighing on investor sentiment too. Anyway, numbers about Alphabet. Their revenues came in at 69.09 billion. They were expecting 70.5, which is a miss of about 2%. That's 6% higher in terms of revenue than it was a year ago. Earnings per share came in at $1.06, expected $1.25, which is about a 15% miss, down 24% from last year. Operating margins were a number that stood out to me. They're 25%. They're down from 32% a year ago, which is a significant kind of fall off in margins. You kind of can infer that a little bit from the fact that revenues were up and income was down. But YouTube revenues were down and operating income was down across that kind of Google stuff segment. They basically have two main bits going on with their business. There's the Google Everything, the advertising business, and there's the kind of cloud business. The Google Everything business makes up about 89% of the revenues, and revenues climbed a mighty 3% in that. That's been growing at around 10% on average over the last decade, and it was up 40% last year, I think. So that's quite the slowdown, but it is still moving forwards. Google Cloud revenues were up much better, up 38%. This is about 10% of the entire business. The thing is loss-making. Earnings per share for the 12 trailing months are now $5.03. The share price is currently around $96, I think, which gives you a PE of something like 19. Steve, what do you think about any of this?
So I thought it was a poor quarter, but I think we'd be lying if we said we didn't really expect it to be something like this. I've listened to the earnings call at length, and I've pulled out some stats from the earnings report and tried to make them as fun as possible for you. So I'll go with what Sundar said first up. He said, "There's no question we're operating in an uncertain environment." I really like pulling out quotes from Sundar Pichai because I think he is almost Captain Obvious. Everything he says is like, yes, we know. But look, despite laughing at them, I think this report still shows the strength of Google's business. So despite the downturn in the ad spend market at the moment, so revenue growth being a mere 6.5% year on year, this is tough comps, as Steve said, and it would have been 11 if we're talking about FX neutral, but it wasn't. Personally, this doesn't matter because Google hedges some of this revenue. It made a $638 million from the hedge, so FX neutrality really giving us that is a nuisance stat, really, I would say. YouTube ads were down year on year. As was Google's network spend. I think this is temporary and will return. Two reasons for this: the general downturn in marketing spend. Two, YouTube is suffering with the Meta problem at the moment. We've talked about the Meta problem before, but quickly, they've got a rival to TikTok that's gaining traction. It's YouTube Shorts, 1.5 billion monthly active users, generating 30 billion daily views. It's not monetized very well as the main content. It's thus cannibalizing themselves, at least temporarily. They've started monetizing Shorts. This went live in September, so most of the quarter was missed in this report. The next quarter, though, we'll be tell you how effective it's been, at least. Especially if TikTok gets banned in the quarter. Cloud margin is the best it's ever been, Steve, which at minus 10% is not worth talking about. When Google crack this, we think it'll be an exceptional business, blah, blah, blah. They mentioned that the vast majority of this negative margin is still servers, as you'd expect in a rapidly expanding cloud business. Google mentioned in the call that customers are taking a little bit longer to decide, and when they do decide, they're taking shorter terms at the moment due to the macro uncertainty. I think all of that is to be expected. So one of the surprises this quarter was that despite a lot of spending on buybacks, they are not making a dent in the share count, and that's because Google's headcount is increasing exponentially. They're definitely hoovering up all the talent that Silicon Valley is cutting out. And to put this headcount in context, in the last 3 years alone, Google has added the equivalent of Meta's workforce to its roster. This isn't a new thing, by the way. Every time there's any kind of macro weakness, all big tech goes on a hiring spree, hoovers up all the good engineers that are leaving. So why is it down? I guess if you can't get it from that, the guidance was pretty cautious as well, and tough comps again, so I'd expect the next report to be as muted. It's down 9%, as Steve says. It looks good to us still, I think. It could be one of the things that we probably go out and buy as a threesome over the next couple of weeks.
Oh yeah, let's do it. Let's have a nice Google threesome, shall we? I agree. Negative things for me on the Google revenue were YouTube, basically. Pretty poor. I think it's been going up sort of 20-30% most quarters, and this quarter it's probably only going up 2%, which is a bit of a shame. I think it shouldn't. I agree with you. I'm surprised the world didn't see lower advertising spend during a potential recession, right? That's basically what we should all be seeing, really. I didn't expect it to come in this bad, but I did expect it to be a little bit lower. As far as the headcount goes, I've been seeing a lot on this headcount, and is Google literally doing the same thing it does with tech companies and buying up all of the tech companies just in case just to make sure no one else gets them? And just in case one of them comes up with a ridiculously good idea that they can patent.
I'm not sure about their kind of acquisitions policy. The thing that kind of stood out to me close to that was that they appear to be basically shuttering stuff. And they appear to be kind of closing down some of their unprofitable things because their margins have shrunk too much and their operating expenses are too high. I'm slightly more surprised than both of you, I think, on this. It didn't massively surprise me that there was some sort of kind of tempering here, but Steve and I have talked historically on this show about what we loosely termed discretionary versus staples advertising spend, and we talked about the difference between whatever it is brand spending and the kind of spending that you can monitor in marketing. And I thought that actually people spend on Google would largely stay where it was because it's pretty easy to see how well it's working, and it's pretty clear it does work. So I thought, well, maybe the marketing budgets will get cut, but they'll get cut from other places first. I don't mind admitting I was kind of wrong about that for what it's worth, but I see this as a kind of report of two halves. There's the revenue growing slowly, which does not bother me. I would take 6% progress in a bad year from Google. I'm all right with that. And then there's the EPS falling, which does bother me actually quite a bit because, and again, this might sound like I haven't thought about this properly, and maybe I hadn't, but I didn't really see Google as an inflation vulnerable company in quite that way. I tend to think of companies that are vulnerable to inflation as manufacturing stuff and things that ship in raw materials and worry about commodities prices. And okay, Google has a headcount to worry about and wages to pay and stuff, but I was expecting it to prove a bit more inflation resistant than this. The comments from Pichai about trying to get that under control in the fourth quarter by shuttering down various kind of unprofitable areas of the business and bunkering down on headcount and so on.
Focusing was the term you
They
used, I think.
attempted to make it 20% more efficient, whatever that nebulously means. I didn't really pay attention to the precise bit of that. But that was kind of encouraging to me. That indicates that he's sort of thinking the way that I'd like him to think here. So I'm okay with slow growth. It's a difficult time for that kind of thing. And there was kind of growth. I'll take 3% or 6% or whatever it is in a bad year. I'd like us to try and keep the margins under control, though. So costs going up worries me. And since I criticised him last week, I will tip my hat to the man Tim Byers, who on Motley Fool podcast recently asked what he was looking for in the big tech earnings that are coming up. He said margins first and foremost, and that's a thing that I wasn't looking out for and is standing out to me and is helping me make a lot of sense. So hats off to him for this one.
Yeah, the problem I'm mainly having right now is Google Cloud, because Google Cloud is that big part that is completely unprofitable right now. It might be because they're offering quite a lot of the storage out for extremely cheap to free. I know that my Google One account is currently something like £15 a month, something like that, whereas if you were to go to AWS or something, it's quite considerably more, especially on Azure as well. But Google is very much third place in the cloud environment, behind Azure and AWS, but it isn't profitable, whereas the other two companies do have and in particular AWS is extremely profitable. It is the flywheel of the business in that sense. And obviously Amazon has its advertising side as well. What do we think about Amazon based on the results that have come out for Google Cloud and Microsoft, which we'll go through in a minute?
Well, that'll be the interesting question, I think. You would expect that. Well, one of the things we talked about when we talked about marketing. Sorry, just to harp back, I'm going to go all the way back to Steve's comment. So one of the problems is that Google itself isn't affected by inflation, but its customers are. So as we were talking off air, you would imagine something like Made.com, which IPO'd last year, is a big Google marketing spend. Inflation has absolutely murdered, and supply chain has murdered that company to the point where anytime soon it should be going bust. I think it's half a penny a share at the moment, from a 775 million valuation, which is just a year ago.
Perfect time for Wall Street Bets to buy, right?
Yeah, or what's his name? Mike Ashley. He tends to like stuff like this, doesn't he? So yeah, I think Amazon. We were talking, before about how Amazon is direct advertising. So when somebody searches for, a beach ball, for example, Amazon is going to bring you up a list of beach balls that you can buy on the spot, whereas Google, you've got to click through, you've got to look at the website, you've got to go through, you've got to buy it. It's an extra step.
Yes,
so
but if I search for beach ball on Google, it comes up with an Amazon advertisement. You know, it's right there, Google Shopping. And that's where I do. If I'm searching for random item, I personally don't go to Amazon to buy it. I just type it into Google, and then I get a plethora of different places that I can buy it off. Usually Amazon is the place to go, but I know what you're trying to say. I'm just, it's not there. By the way, I do agree with you on the advertising spend thing. I think that advertising was something that was supposed to go, and I think you'll see that in Facebook's.
Well, here you go. I learned something the other day, that us old folk are the only ones who use Google. Young folk do not use Google to ask questions in the way that we do. They go to TikTok to ask it, or they go into Amazon to type in their searches and things like that. So when younger folk are looking for items, they don't go to Google to do any comparison or anything like that. They go straight to Amazon, they go straight to TikTok, and they ask the question directly, which is why sometimes when you're on Reddit seeing me getting incensed of somebody who's asked a question that they could have just Googled and got the answer, it's simply because that's the way the younger generation is essentially searching.
So you're telling me, right, I know, because I've heard that phrase before, that they go onto TikTok to do their search and they do their learning, and I understand that's fine. But you're telling me in that they click on that spyglass and they say, what color is this, or whatever their question is, and they expect somebody to have released a video.
Yeah, or answered it on one of the Yahoo Answer sites or something like that. Yeah, they expect to find it, that way. But yeah, that's interesting. It's just a different way that people search. So that's the beauty of Amazon's marketing, anyway. Is that it is a direct consumer sales. AWS, I would have expected to be experiencing all the same problems as everybody else, but probably without the massive margin pressures that Google have. AWS and Azure are much more mature products than Google Cloud. Google Cloud's on kind of a rapid expansion to catch up. It's third place. I think it's probably going to end up staying third place. I think AWS and Azure will fight for first place. Google will end up a smaller competitor. But when Google isn't buying servers or putting as many servers in as possible to try and meet demand, and it starts just selling the space it has, then you'll start to see Google Cloud turn a profit. That's the stage that Azure and AWS are at. They've got the space, they just need to sell it. Google is building out and selling, which is why they've got negative margins.
That's fair enough. Yeah. Well, Microsoft, we're talking about Azure as well. Microsoft came in beating everything as far as I can tell. The expected EPS was $2.30, and they got $2.35 per share, and the revenue was $50 billion, expected $49 billion. But guidance was the biggest thing. We've been talking about guidance here that has affected Microsoft, which might be why their share price hasn't dropped as far as Google's has today. But they're expecting a lot of problems, let's say headwinds going into the cloud sector, and maybe that's affecting Google because of this specific third place, and the build out, like you're talking about.
I think Microsoft's report is absolutely fine. Their guidance, I don't think their guidance was a massive problem either. They're basically saying we're still going to grow, but it's going to be quite slow. They said that the PC sales are causing a bit of a headwind at the moment. But I think Google's report is what's hurt Microsoft the most here, because immediately after this report, and whilst they were giving guidance, Microsoft was up a couple of percent. It was only when Google finished giving their guidance that Microsoft's price got slashed a little bit. So I think this isn't a case of Microsoft and Google going down. I think this is a case of Microsoft being okay, but Google dragging it down with some poor guidance, which would affect Microsoft's already weaker guidance. To be fair, I think Microsoft are absolutely sandbagging us here. I think they're setting expectations low, and they're going to beat them quite comfortably. But in terms of Microsoft, I think it's a really boring company, Microsoft, because it just does exactly what it should do. It sets expectations and it beats them marginally. There's very rarely any shocks in Microsoft earnings. There's very rarely any shocks in their guidance. So yeah, I didn't have much on this, Steve. Do you have much?
I don't have a huge amount on Microsoft. I thought this was a kind of modest, tapered guidance for what it's worth. And I suppose 6% off is sort of fairly modest. It's certainly modest compared to Meta Platforms that I'm looking at reporting right now, which is down around 8% and has missed on top and bottom.
Ooh, interesting. So, that's good, because they've started to report now. I didn't know that was tonight. They were down 5% today. I was looking today.
They were down 5% today. They were down some amount after the Snap thing. They're down another 8% in extended hours trading. Their earnings per share are 164 compared to 189 expected. Revenues 27.71 billion versus 27.3 expected. So that's a beat, I think, on revenue. It's a miss on earnings. Daily active users is in line. Monthly active users is slightly higher. That's not what I was expecting from this stock, actually, but there we are.
Yeah, it's advertising spend, isn't it? It's what they're sort of thinking. When we're saying that it's beating estimates, that it's still down. It's got to be down like 15-16%, something like that. I'll have to check that. I can't fact check that right now. But that's got to be around that sort of year on year. That's going to be down that much. Amazon also down 4% today, and that might be the last one, right? That's going to be the last big kicker, I think. When do Amazon report? Do you know?
Tomorrow, I think.
Yeah,
tomorrow, I think both them and Apple report tomorrow, which I think also has the capacity to be a fairly big kicker here. There's demand concerns around Apple of a sort that I'm interested to hear more about, since I own that stock.
Yeah, once the Amazon earnings come in and what we see from AWS, whether it hits expectations or it doesn't. If Amazon misses on AWS, even though it's still going to be strong, it's still going to be growing at 30, maybe 40% at least, right? But if it does miss, I think you're probably going to see Google and Microsoft get dragged down a little bit with it. We'll see how that goes. This is going to come out Sunday, so we'll know way before Sunday whether this was real, and I can just cut this out of the podcast. But yeah, very interesting to see in big tech right now. What's the crack? Are you going to struggle to buy all 3 or 4, or are you going to focus on one? What do you think you're going to do?
Well, I think I'm going to take the Cathy Wood mantra here, and if Amazon and Google fall a significant amount, then they're going to be the focus of my attention. I don't actually own Microsoft in my portfolio. I don't think I always feel like I've missed the boat on Microsoft. But if it was to fall a lot, then obviously it would get interesting. To be fair, I don't see that happening in my head. I think Amazon's been quite lucky in that its retail arm has had Prime Day. I would expect that its marketing would have done okay, and I would expect that AWS would continue to be the juggernaut. So I don't think this is we'll find out, but I don't think this is the quarter where we should really worry about how Amazon's done. I think they've had another Prime Day in the middle, or some kind of special Prime sales. They've actually had it twice in this quarter. So, I mean, that might mean that retail is very weak, or it might mean that retail is quite strong and they're trying to capitalise on it before it gets weak. It's one of the two. We're going to find out on Thursday, and I suppose I could just cut that so I look really smart.
No, I like this. I think we disagree on this, and it'll be very interesting to see, because there's obviously absolutely no way of coming out. But when you mentioned the second Prime Day, I had been thinking about that, and I saw it the other day, and I went, "Why the fuck are they having another second Prime Day?" And that to me just feels like, I feel like in their earnings they're going to merge the two and say, "Oh, look, Prime Day got this," and it's going to make it look like the normal amount. But we are actually going to see, because they don't have to report that, but we're actually going to see that they had to do 2 to get the same amount of earnings, or it might even surpass. Actually, now I think about it, it will surpass, but they'll merge the 2 Prime Days together to get a good figure. I think. Like I said, I'm not worried long term. Long term, this is perfectly fine, isn't it? But we're looking at entry points now, aren't we? We're looking at good places to get in. I'm looking at Amazon's price today, and it is now below where I sold it initially, which is quite good. So that's going to be a really good thing for me to look in. But are we? Yeah, big tech wise, I'm assuming we're looking at all of them. I'm looking at all 3. But I don't know if I'd weight as much towards Microsoft, similar to what you guys are thinking. But is it going to be easy to spread your money across all the big tech at the moment, or do you think it's over?
Well, it's easy for me. I deposit every month, and if something there is of value, then I will put into it. It's going to be very easy for me to spread the money between. I've still got quite a fair amount of ISA deposit left, actually, for the first time in a while. So I'll be quite happy to put the rest of it into Google and Amazon if need be.
Yeah, were it up to me, I would happily buy any of those 3. I'd probably lean Google and Facebook right now. Steve doesn't own Meta, so building out the ones that he owns. I would be happy continuing to buy that, probably. I haven't looked through the report entirely on that, so there's a kind of biggish caveat there that I want to have a closer look at what's going on with that. But by and large, I think what I'm learning here is that these are perhaps more cyclical companies than I initially thought they were. Maybe I should have realised that. But learning that things are cyclical and that you're therefore meant to treat them like cyclical, what do? You buy them when they're in a down part of the cycle.
Yeah, there's no evidence to say that they're cyclical as such, but it's just a historical idea of, it's the new form of advertising, isn't it? I reckon if we looked at ITV or something like that, we would see horrible numbers going out, and maybe even some initial US cable TV. I think we'd see horrible ad spend there, and like you say, I think it will definitely go from there first. And I think what we've seen is it's already had that transition. I think cable and network TV in the US now is left to the Cialis adverts, and the guys making just trying to come up with euphemisms for taking a shit and not being able to. But they're always going to stay with the network because the old people are in front of the TV still. But actual younger person advertising, more modern advertising, and things that cater to young families, I think that's already moved over to Google, Facebook, Instagram, etc. Maybe even TikTok. I can't really give you too much on TikTok, but I think that's already moved over. So we're seeing. So I don't think what you're thinking there is that we should have realised it's cyclical. But maybe this is the first nose for us to realise that this is where these mature businesses are going to go, and they're going to become the new cyclicals as far as that goes, if they don't continue spawning and blah blah blah.